Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
What if I told you that you could deduct your car loan interest from your taxes, kind of like you do with a mortgage? Well, for a little while, you actually might be able to. A brand new tax law has just opened up this short-term window that honestly could put thousands of dollars right back in your pocket. So let's break down exactly who qualifies and, more importantly, how you can claim it. So what's the magic number here? It's this one, $10,000. That's the absolute maximum amount of interest you could potentially write off every single year, depending on your loan. That is a serious chunk of change that could make a real dent in your car payments. This is actually a first for U.S. tax law. We're all used to deductions for things like mortgages and student loans, but never for a personal car. But here's the real kicker. It is temporary. This window is only open from the beginning of 2025 all the way through the end of 2028. It's really designed to give car owners a bit of a break while interest rates are so high. Okay, but before you start planning how you're going to spend that tax refund, you should know there are some very specific hoops you've got to jump through. The first one, and maybe the biggest one, is all about the car itself. So let's dig in and see if your ride actually makes the cut. So there are 5 key things your vehicle has to meet. First up, it has to be brand new, and you have to be the very first owner. Second, and this one is a huge deal, it must be finally assembled right here in the United States. Now, the good news is that most common vehicle types are covered. Cars, SUVs, trucks, you name it, as long as they weigh under 14,000 pounds. And the final rule is absolutely critical. This is for your personal use only. Business use or any kind of lease, they're out. Let's really focus on that final assembly rule for a second, because this is the one that's going to trip a lot of people up. This isn't about the brand of the car, right? It's about the specific factory where your exact car rolled off the line. Thankfully, there's a super straightforward way to check this. The key to all of this is your vehicle's VIN, the vehicle identification number. Think of this 17-character code as your car's fingerprint. It holds all the details about its history, including the assembly plant. You can usually find it right on your dashboard, through the windshield, or on the sticker inside your driver's side door. Okay, so once you have that VIN, you're going to go to the official government website run by the National Highway Traffic Safety Administration, or NHTSA. It's easy. You just plug in your VIN, and it'll spit out a full report. You just scroll down to the section that says Plant Information, and you need to make sure it says United States. Simple as that. Okay, so your car qualifies. That's fantastic. Now for hurdle number 2, your income. Like with a lot of tax breaks, this one is really designed to help middle-income families, so there are some pretty specific income limits you need to know about. The specific term the IRS uses is your Modified Adjusted Gross Income, or MAGI. Now, it's really similar to the AGI you see on your tax return, but it just has a few specific deductions added back in. For most people, your AGI and MAGI are going to be almost the same, but it's that MAGI number that really matters here. So the way this works isn't a hard cutoff. It's what's called a phase-out. If you're a single filer, your deduction starts to shrink once your income hits $100,000, and it disappears completely at $150,000. For couples filing jointly, it's easy. Just double those numbers. The phase-out range is between $200,000 and $250,000. Let's just walk through a quick example so you can see how this works. Let's say you're a single filer and your MAGI is $105,000. So you're $5,000 over that initial threshold. The law says your deduction gets reduced by 20% of that amount you're over. So 20% of $5,000 is $1,000. That means your maximum deduction isn't $10,000 anymore. It's reduced by that $1,000, which leaves you with a max of $9,000. Okay, so you've cleared the vehicle hurdle and the income hurdle. Awesome. There's just one more step, the loan itself. See, not all financing deals are created equal in the eyes of the IRS. So this deduction is for new loans on new vehicles starting in 2025. The good news is that if you refinance a loan that already qualifies, that counts too. So what's explicitly not allowed? Well, any loans from family members, the IRS is trying to stop people from gaming the system, and any loan on a car that has a salvage title is also a definite no-go. So, just to hammer this home, let's recap the loan conditions. It has to be for the initial purchase of a brand new car. Your lender has to hold the primary lien on the vehicle, and if you do refinance, you can't take cash out. The new loan can only be for whatever amount you still owe on the car. So let's say you check all the boxes. Your vehicle qualifies, your income qualifies, your loan qualifies. How do you actually claim this deduction and get your money? Well, the process is actually surprisingly simple. Now, this is pulled directly from official IRS guidance. It looks like a bunch of complicated government talk, right? But what it means in plain English is that you don't have to track the interest yourself. The law now requires your lender, your bank, your credit union, to do all the work for you and give you a statement with the total interest you paid. The key takeaway here is the deadline. By January 31st of the following year, your lender must get this information to you. So you don't need to go digging through a year's worth of statements. Just keep an eye out for a new document in your online banking portal or in the mail that clearly shows your total auto interest paid for the year. Okay, let's recap with a simple little action plan. First, if you're out there shopping for a new car, check its assembly location using that NHTSA VIN decoder before you sign on the dotted line. Second, get a good honest estimate of your modified adjusted gross income. Third, make sure your financing is a standard auto loan, not some kind of personal loan from a relative. And finally, keep an eye out for that interest statement from your lender early next year. And that brings us to the final thought. This is a really powerful incentive, but remember, it's temporary. It's set to expire at the end of 2028. So the big question is, what happens then? Will this short-term tax break actually be enough to change how people buy cars for the long haul? Maybe pushing more of us toward American-assembled vehicles for good? I guess only time will tell.